This episode of Folico Live. We've got some analysis coming up here that we just couldn't wait over the weekend to start throwing out there and delivering to you, our audience. So we've got to get into it today. Tyler and I have been thinking and talking a lot about some things lately, especially the market volatility. Now, I want to show you a quick image that prompted us to start thinking we've got to do an episode on Friday. There's no waiting for Monday to get this out. So let me show you what we saw in FactSet this morning. So here we have the U.S. stock index futures from August 18th to now, and you can just see this huge plummeting S&P 500 and the NASDAQ 100, and SPY down this morning. Really, some big issues happening there. Now, this looks like it's going to be breaking SPY's 4-week streak of being up week over week, and this is starting to bring into question. Is the market potentially hitting some friction right now? There was some hope that there was a bottoming in mid-June and that we're really on that upswing, whereas Tyler, Mr. Optimist, has been saying, no, there's going to be a third leg down at the 4,300. Well, guess what's happening? It's starting to shape and fit that narrative exactly. So, Tyler, what is going on here? Are we seeing a third leg down? Is it potential that we did see some bottoming? And then we want to take a look at the data today. Let's get numbers forward. So, Tyler, what are you seeing?
Yeah, so we'll pull that way back up to the top. So we've had kind of an overall overbearing thesis that September is probably the likely bottom. We see probably one more shakeout here against 4,300. We're not super clear on new lows. If the market's going to bottom in September, that probably means no new lows. It probably just means a pretty scary, week or something like that. But what I thought was really important was, I think it was last weekend when I was doing my weekend reading, somebody published a chart basically that looked something like this. So this is RBOB gasoline in bars, and then the line is the S&P returns. And basically the argument they were making was this is all gasoline effectively. The change in price in gasoline is what is causing such friction for the consumer. That's what's upsetting the apple cart and really feeding through and is really explanatory in terms of driving risk. So, I've been doing this a decently long time and have seen some very spurious correlations and lines that match each other, right? So that's something that I always like to look at, and that's what I'm excited to do here. Is we actually looked at, does any of that actually matter, or are those two lines on a chart that just kind of are coinciding but not descriptive of each other and not useful in terms of risk-taking decisions.
So that led us to do some deeper analysis and investigate. First off, let's do some exploratory data analysis for all you data nerds out there. You're going to recognize that EDA phrase. But let's get some correlations out. So we've got a few things for us to look at, a little bit of ammunition in our toolbox here. First thing I want to pull us towards is Folico and Cinerai. If you've been under a rock this whole time, we produce 6 health scores that do a whole bunch of really interesting things in terms of collecting all of the world's news and consolidating that into one central view on how 1,100 different tickers are doing, how 11 different sectors are doing, and then finally, what's relevant for us today, how the market itself is doing. So let's take a look at that. This is the homepage of Folico today. You look here, there's a button here, a toggle market outlook, and you're able to get those same 6 health factors on a market level. Now, what we see here is the gray line that represents the average of all 1,100 companies. So this isn't going to be SPY. It's not weighted or anything like that. This is just the average movement, our entire coverage list. But the blue line is our systemic factor. Now, what is systemic? Well, systemic is all the impacts that you get from global, regional, national events that form society-wide, economy-wide impacts. It doesn't necessarily have to do with how this particular company or how a specific ticker is doing. It has to do with input prices and things like oil, supply chain difficulties, all political friction, everything like that, right? Or a trade deal goes south really bad. Those are all things that would affect this systemic factor. Now, what we're doing here is as we're building additional models to more precisely predict SPY all up, now we're wondering, well, what effects can we get just right from the systemic factor? And you see here over the last 6 months, here's what this has been looking like. Okay. But the one issue with this is when you start looking at systemic, you get a little bit myopic. And if you're looking at just the last 6 months, yeah, you get some interesting views, but how do we form an overall thesis that we can then apply on this 6 month view going back to 2017, the last 5 years of data? So that's what we prepared for you today. We want to take a look at the data when it comes to just that. Now, what we're going to start off with is just some simple correlation. And we're going to get the first thing I want to pop up here. So this is a matrix right here. You'll notice this is the correlation between systemic and systemic. We're going ever since the year 2017, January 1st, 2017. And so, of course, the correlation between a number and itself is going to be 1, right? Now, this number can range anywhere from -1 to 1. And what you'll notice is a weak correlation that data scientists wouldn't really pay too much attention to is, and this is kind of rule of thumb basis, but anything under 0.3. So if it's between -0.3 and +0.3, what you'd really say there is there's not much of a strong correlation to really pay attention to. Then you have your medium or weak correlations, anywhere from 0.3 to 0.6, okay, that range. And that can be on the positive or negative side. Remember, this is two-tailed, two-sided, right? So -0.3 to +0.6, you're going to say there is somewhat of a relationship there, okay? From 0.6, or some use 0.7, up to 0.9, that's when you're saying, oh my goodness, there's an extremely strong relationship here. This is something for us to pay attention to. If you're above 0.9, you've picked up something too much. It's too much. I don't trust it. Okay. So there's some data nerdage for you for us to have a framework to go forward with. So RBF, that's RBOB there. And then we have SPY. So the correlation, let's forget about systemic for a second. Let's just focus on the relationship between SPY and RBOB, because that was our original thesis. And what we see here is a positive correlation of 0.54. Tyler, can you bring up your graph that you were pointing out, the correlation there real quick? All right, so while he's pulling that up, and go ahead, yeah, just drag it into the screen. Could you zoom in on the left side being mid-21, the right side being today? Is it possible to do this with these graphs?
I mean, we can kind of do something like that.
You can't zoom in any further?
I mean, if I zoom, we kind of lose.
Okay, all right, we can bring it up. There's two things that I want to point out. And actually, you know what? Instead of that, let's just plot it ourselves over here on this graph. There we go. Pi RB equals F. All right. There we go. So here's what we have since 2017. Now, there's two kinds of moves that these lines can be making. If there is a relationship, we notice in the correlation we're getting some strong numbers, that can be either positive or negative. If it's positive, then that means what you're going to be seeing is what we call sympathetic moves. When one moves, the other also moves with it. Okay. The relationship that Tyler's been talking about has been converse moves, which means that when one moves, the other one goes down, right? And what we see is strong converse moves happening since mid-2021. Which does say that, that theory could be happening. There's not a great way to evaluate this with the data because these moves are happening like instantly if they are. They're happening almost at the same time. So I don't know if people are seeing gas prices go up, therefore I need to short the SPY. That is one consensus that you could come out with. It's not a very trustworthy consensus. And for you at home, I don't think that this is intelligence that you can actually use. Because if that is the case, then that means these big Wall Street institutions will have already caught this effect and have all their systems tuned in to capture it as fast as they possibly could. And then you get into a flash trading stance, and it's really about who has the shortest cable between Equinix and their trading platform. So at home, my point is, if that is the case, you're not going to be able to make much money off of it. I don't have that kind of Equinix presence, so I'm not going to be able to make much money off of the flash trading effects there. So not really a great thing to be using. Yeah, we're not financial advisors. Work on your own risk tolerances. But what we see before 2021 is the exact opposite relationship, sympathetic. And in fact, it's that sympathetic movement that is causing the entire correlation to be in the positive realm. So, what I'm going to say here is although that's an interesting graph, I don't think that the hypothesis is necessarily either valid or useful going forward. Okay. However, I think that there are some things that we can dig into. Now, remember what we're picking up with sympathetic. And I'm going to take away our screen shares here for a second so we can talk. Remember what we're picking up in our systemic factors. We are picking up oil prices. We are also picking up supply chain problems, right? We're also picking up a whole bunch of other elements, different input prices changing and elements like that, trade agreements. Now, notice here that we've got also a pretty strong relationship. Well, we have an extremely strong relationship with RBOB and systemic, right? So let's bring this screen share back up. Minus 0.8 with RBOB. But not just that, but we've been able to really increase the relationship with SPY, minus 0.62. This starts getting pretty exciting in that we have an indicator that can line up with the S&P 500 so well. So we started digging into this. How do we make this look even more interesting? So let's pull out and get rid of RBOB and let's zoom in on systemic. Okay. All right. There's some interesting things that we started noticing when we zoomed in on this. First off, look at this huge downturn in our systemic factor. And what do we see? About 6 months later, 2018, that market pop. All right, we see a rally. We're going forward. We start to see some dips, but I'll be honest. If we look at the data and we're really intellectually straightforward here, I'm not going to say that we necessarily caught any kind of downturn that would hint that we should have been shorting here in February 2020, right?
Right.
Someone caught a cold. I'm sorry, I don't mean to minimize COVID at all, but a disease swept the world, and it was a very serious, terrible disease, but that was an exogenous factor that our model did not pick up at all, right?
Correct.
However, so we saw this supply chain weakness happening here, end of 2020. And that supply chain really knocked down our systemic factor in a huge way, but then it kind of leveled out for a little while. We said, yeah, supply chain difficulties, but we're actually still in the positive realm when it comes to market-wide systemic factors. However, end of Q1 2021, we see this absolute destruction in our systemic factor. And about 6 months later, the market absolutely pukes. 6 months later, we kept seeing this happening over and over again. Signal, 6 months later. So we started to see, well, what happens if we can plot these two together? So this is my data mine. I'm going, nerd status here on you, Tyler. Thoughts so far while I pull up this next graph?
I mean, this is real macro analysis to me. This is using a leading indicator to predict price and therefore paint a backdrop for your risk taking framework. That's probably one of my favorite signals in Folico is just the market-wide systemic. It's something you and I have done a bunch of work on trying to turn it into a way to just trade SPY and QQQ and IWM, straight out instead of trading single names and using it for context. And the amazing thing is it actually works, right? Like we can put in front of you right now this statistical analysis that, I think it gives pretty good credence to what our systemic factor is picking up, and that it's actually valuable in your investing framework.
By the way, John Tomesco, haven't met you yet, but how you doing? It's great to see you. Thanks for joining us.
He's a good buddy.
Yeah, good to have you with us, John. All right. So now let's look at something interesting. We're going to take that systemic line. Now remember, here's what the systemic is. This is the 90-day moving average of our systemic factor, which is why it looks a little smoother. If I don't do that 90-day moving average, this starts to look pretty messy. Okay, so we are going to pop this out to a 90-day moving average. And we're only going to care about this if it's predictive, right? So what we're going to do is we're going to take that whole systemic line and we're going to follow our thesis here and just shift it over 6 months. And let's see what we've got here. this is, again, this is fairly predictive because we're drawing a line in the sand. We're saying 6 months ago we saw this weakness. Here's what's happening.
And by the way, before you get into this, did you perform any 1/log times Batman symbol plus double helix here to goal seek or force this in any way? What that is not completely natural have you done to this relationship in this graph? Because I think that's very important because we actually have an answer to this.
Yep. 90-day moving average, shift the line. Now,
That's
to
it.
get this line was some incredible mathematics in order to, take what everyone around the world is saying and congeal that into one solid view about how the world works. Yeah, that's some Batman signal mathematics. But now we've got this output line that doesn't care about anything. It is what it is. And now we're able to say, shift that over a little bit, and you've really got some soup, right? So
What we're saying is this is a leading indicator, is like a real leading indicator. And I think, that's pretty cool to say the least.
yeah. Well, look at this. End of 2018, 6 months forward. Look at how well that lines up. I mean, you're off by like a few days there, right? We see huge market strength, a dip in that momentum. Now, here's what we're seeing. We're still in the positive realm, but we are seeing a rapid decrease in that score right here. So why no dip, Tyler? I brought this up when we were going through the data. You had some interesting thoughts on this.
And our hypothesis is the power of the combined fiscal and monetary policy hose in the U.S., where they just turn the taps on and we're creating all sorts of liquidity, drown out all of the nasty things in the background that COVID had caused, i.e., the shot up in energy prices, the supply chain backlogs, all of the things that were deleterious to the actual economic activity were completely masked because it's all good if you just keep getting a check in the mail. So that's kind of our hypothesis, is the power of monetary and fiscal policy both just completely overwhelmed what was, quote, fair value.
So, and all those dollars having the impact of basically skirting our systemic score sideways for a few months until we saw the exact same shape and curve continuing downward until that 6 month forward would have said right at this point. Now that's pretty incredible. So now this is helpful. This is interesting. Everyone is a fantastic stock analyst when they're looking backwards, right? But how do we look forward? So what are we saying about the future? And remember, that's where we came from. That's what we're looking towards. What we are seeing is our systemic factor did start seeing a little bit of a rally here. Not as much going forward, though. We are seeing some deterioration of that score again.
And this means,
go ahead.
And that's what's informing our short against 4,300, basically. On a macro level, it's because of this. We see this divergence, and that's something we want to attack. That's basically what's been informing our, okay, you guys can reshort. We probably could have done a better job being long from the lows, just based on that bounce. But that's what this is saying. It's saying, time for a reshort.
Perfect. And if we are going to see a bottom from these numbers, when is that bottom? Well, let's undo the shift. Remember, this is going to be 6 months forward, right? So you're going to have to drag this out. 6 months forward, once we get over that dip, we are seeing it in the September timeframe. So going from about March to May, this time frame here, that's where we would have seen our bottoming out. 6 months forward, we're looking at September, October timeframe. We'll have to see how this works with today looking like a pretty rough day for the market.
Yeah, it's getting nasty out here. That's
what are we at?
If you guys see my eyes darting around, it's because, one, I got a couple positions on, and two, this market's catching the head body. QQQ's down about 2% here. Broke what I think is pretty decent, was decent support at 323. SPY at 420, almost down to all the way to 420. So that'll be interesting. We certainly think that we have one more bout of weakness before the final, we stick our flag in the ground and start to buy. But I mean, I got to be honest with you. I really think what that analysis showed and what we did today is really a good thing in terms of showing people like this is how you're supposed to think about taking macro risk, not like gambling on like weekly options. You have a model that works well. It times out a divergence, and you strike at the most opportune time where you have the largest edge, which allows you to take the most risk, right? Because you're allowed to take more risk as you have a larger edge. So nobody's doing this for free on YouTube. This is institutional quality stuff. I think we've just proved to you we have a legitimate leading indicator in terms of SPY, which I think is a pretty big deal. This is something we will keep in front of you. We'll be using it to trade, definitely. But this is what I think we do best. We bring markets, kind of thoughts and old adages, and we actually have the ability to put the analysis behind it and kind of figure out what's important, which I think, given there's so much noise out there, figuring out exactly what you need to be watching and what's moving price is paramount.
Well, and it does show you, as you're seeing short after short after short on our earnings predictions, we do have a view and a horizon at which we think that things are going to improve. Now, this indicator, we're going to keep our eyes on it. Could things happen? Yeah, things could happen. It is in the Democrat Party's best interest to make the economy look as shiny as it possibly can right now.
Right.
The Fed's not helping them with that. All right, so this is great. I do want to show everyone this. Front page of the Wall Street Journal. Wall Street bets the Fed is bluffing an inflation game, despite the fact that they've said, no, guys, we're super serious this time. We're like super duper serious. So what's going on with the Fed, Tyler? Because this seems like a huge question, and it seems a little bit like a gamble. Is there anything data-based, or is there anything more than a gamble that we can rely on right now? I mean, the nice thing about our systemic factor is it doesn't really it picks up so much of the huge picture that it's not over-reliant on just one thing like the Fed. It's going to be picking up things like CPI inputs. It's going to be picking up things like raw materials that then gets boiled down into CPI inputs. That's why it's a 6-month lag, right? So we're not overly reliant on the Fed when we say we do see a turnaround in September, October, right? But at the same time, I do think you can still get burned by just market reactions to everyone else finally realizing the game's afoot, right? So how do we prevent that?
It's really been wild because we've had such strong risk reactions to, such massive hikes, which, I mean, I talk about positioning a lot, and, sometimes stuff won't go down anymore. Those, no matter what the market tries to do to it, it's just, we're out of sellers or we're out of buyers. And that allows price movement to be somewhat convex in the favor of where the positioning isn't. Right. So if everyone's long, it's always going to favor the short side. The drift is always going to be, not always, but generally speaking, will be to the short side. And that's really the question. Like I say, the whole market is basically the 2023 Eurodollar curve, steeper, flatter. That's it. Will they be cutting? Will they not be cutting? God forbid, will they be hiking?
You mentioned something. You were talking about US dollar or euro dollar this morning, but I didn't quite follow that. So what was that? And help our audience follow that along.
So there's two things. There is euro dollar, EURUSD, the currency, and there are euro dollars, the interest rate futures. So when I talk about euro dollars, I'm talking about interest rate futures that are largely driven by where the Fed policy rate is, as opposed to EURUSD, which is basically, I mean, gosh, there's many things that drive it. Interest rate differentials between the two countries and the two central banks, flows. I mean, it's literally an entire PhD degree. So basically, what I have kind of been brought up on and learned is rates higher, dollar stronger is not always good for risk. It's good for risk when we're coming out of an economic trough, because that means everything's improving. That means oil's moving higher. It means economic activity is moving higher. Rates are moving higher. The dollar should, on net, be moving higher. But basically, the dollar is like the dollar and real interest rates, which really drive the dollar. Basically, and the sorry, I just get super jargony sometimes when it gets to rates. Real rates is basically the equation, the subtraction between the nominal and the tip. Well, that's
Tyler,
for the break
I
even.
just want to say I'm really happy. I no longer feel like as much of a nerd.
Oh God,
you have exceeded me, my friend.
Rates are terrible. But yeah, so I mean, it's three parts of an equation where you just basically move around what you're solving for, the real, the nominal, or the inflate, and you can get different things out of it.
But incredible complexity going on here. But it
It's
sounds like
grossly
what we're
complex.
seeing here is a bad sign for the near term. That this,
Yes, backing up, yes, stronger dollar generally is, given the dollar is the foreign reserve currency, most of the borrowing occurs in dollars. So if your currency is the euro, your loan is getting more expensive as the dollar is running away because you have to buy more dollars to cover the same. You have to buy the same amount of dollars, but it costs more to buy your dollars to repay the same size loan because you're not
almost at a double interest rate increase on that.
Yes, and there are things that corporates will do. They'll lock the FX. There are interest rate forwards you can use to mitigate that. So there are ways to do that, and companies do that. And that's I believe you saw Microsoft talking about they had some FX adjustment issues, which basically means their hedging desk did a bad job. That's what that's code for, is whoever's running the hedging desk had the wrong view, used the wrong strike, et cetera, et cetera.
But hedging FX is going to be a risk no matter what you do, right? So I know you're de-risking the FX exchange, right? But that's not a cost-free transaction, which means that having to do that still means you're getting a double transaction increase on
Yes, there is
going up and the FX.
Yes, you're basically locking in and agreeing to, all right, like in order to hold this steady, it's going to cost me whatever 1.5% over 4 months, and I agree that paying that premium is acceptable to lock everything else I have in place. Because if you're Pepsi or you're Coke, you're talking about gigantic, billions and billions of dollars of contracts that as long as the hedging costs are reasonable, and these are very, very liquid. Most of the sell side has a designated desk for making markets to corporates, talking to corporates. So this is, they're very well served in that spot. So it's not very expensive to put the hedges on. But yeah, I mean, it is a double whammy if you have to put the FX hedge on, because you are implicitly paying some sort of premium for the right to insure, basically.
Well, you're not going to get that de-risking for free.
Never, right? Yes, nobody's going to warehouse your risk for free, right? You're always going to have to pay them a rental fee, basically.
Yep. All right. Well, I think this gives us a ton to chew on, Tyler. I think that what we have here is a pretty incredible system. This has been a lot of fun doing this analysis. Last thoughts before we need to get running?
Yeah, this is something new for us. This took us, quite a bit of time, and by us I mean it took Travis 80% of the time and me 20% of the time. So if you like this video, please hit the like button, please comment below. And we're happy to do this, but we don't want to just be, shouting into the abyss. So the more likes and interactions that this video has, the more that we will be willing to bring out, some pretty advanced, pretty interesting stuff.
And I'd love to see pushback. Where on our charts do you not see what we're seeing? So to our viewers, what do you think of that oil price relationship with SPY? How are you positioning going forward? Let's get the conversation going. All right, Tyler, thank you for the time. Thank you, everyone, for joining us. And we will see you on Monday, bright and early, 8:30 a.m. Eastern Standard Time for Foliko Live. Have a great weekend, everyone. We'll see you soon.